Hi guys, it's Sam and welcome back to the old channel, or if you're new here, it's nice to see you. I hope you stay tuned. Now in today's video, I'm going to be sharing some of the most common mistakes first-time buyers make when buying a home and how you can look to avoid them. So if you're interested in learning what not to do when it comes to mortgage, then I highly recommend you subscribe to our YouTube channel. It's dead simple. Just scroll down the page, hit subscribe, and you'll be here when we make any uploads. Now anyway, I've gone into the intro enough. Let's sit down and get into it. Okay, so number one, not saving enough money. Now, I'm not talking about the amount of money you need to save for your deposit. I'm talking about not saving enough for the fees that come along with it. Now, when you buy a home, you're going to need help from other professionals. Let's face it, we're not all experts at this sort of stuff. So additional fees charged by solicitors or surveyors are the main thing that people tend to forget or don't even realize exists. So when you are looking at buying a house, make sure you've got them costs accounted for so you don't leave yourself short. Number two, is a little bit similar to number one, but underestimating the cost of actually owning a home. So many people think it's simply the mortgage repayments and then they find themselves unstuck as they've overstretched themselves because they've maxed out the affordability and basically bitten off more than they can chew. So there's so much more to own in the home than just the mortgage payments and deposits. You've got bills like energy, gas, electric, TV license, Sky packages, even your home and personal insurances. Now your advisor and lender will apply a strict stress test, get me words out, when they're determining how much you can realistically afford to borrow. But it's also worth ensuring that you know exactly what your total outgoings will be every month to avoid any sleepless nights questioning how you're going to pay for these come the end of the month. Number three is not getting a mortgage in principle, AIP, MIP, mortgage promise, whatever the hell people call it this day and age, because there's a lot of names for it. But since buying a house, especially for this time, is so goddamn exciting, many people end up getting way too excited like I did and head straight to Rightmove, Prime Location, social media, all those sorts of places and book viewings without getting their financial affairs in order. So a decision in principle is a certificate given by the lender stating how much money that they will lend to you in principle based on how much you earn, the information we give to them, and a quick credit check as well to prove worthiness. Now the problem with not getting one of these is that since the housing market is so competitive, not having a decision in principle could mean you're actually going to lose out on the property if you don't have it in place. And finally, number four, taking out credit before applying for a mortgage. Now, honestly, please listen to me on this one. Now, until your mortgage application has been fully approved, do not go out there and start taking out a credit card or apply for new car finance because it seems like a good deal or anything like that. Now, lenders will closely look at your credit history and score, which means they'll look at your debt to income ratios. And by debt to income, I mean how much your personal debt levels are versus the income that you receive. And as we know, applying for credit can impact your overall score. And a small reduction in your credit score, or any amount of new debt for that matter, could be the difference between you being approved and you being declined. And although it's quite rare, it's also possible that a lender might rescind the mortgage offer up until the day that you got your keys. I've seen it firsthand. A client went all the way up until the day of exchange. The lender carried out a final credit check before releasing the funds, and you guessed it, a personal loan. It was 10 grand for debt consolidation that had been taken out, and then it was declined. And there was nothing we could do, and that wasn't a fun situation for anybody. So please listen to me when I say it. Don't take out any more debt or credit if you are during or about to make a mortgage application. Now, I could go on and maybe I'll film a part two of this series, but if you do want me to go through anything else in terms of what I've just discussed there, please let me know any questions in the comments below and we'll get them answered for you. And if there's any questions that you do have from today's video that you want to speak to me direct or any of the team, please make sure you drop us a message or you can give us a call on 01925 573 328.